Vital Farms stock is cracking, but the yoke's on the bears. Are we in store for more pain, or is this a generational buying opportunity? I'll break down my thoughts in this video. And if you like lukewarm puns or are interested in Vital Farms stock, you've come to the right place. I called it. My bear case on Vital Farms was $14 to $16 a share. And I'm going to play a clip from my last video because how we got here is a little bit different than what I predicted.
So the bear case is about a 30% drop from today's current price, which again is about $20.30. And bear case, we're looking at about $14 to $16 per share. Now, the bear case just doesn't happen after one bad quarterly earnings. This is like structural. This is something that will happen over the course of like 2-3 earnings, right?
All right. Well, I'm gonna stop it there. I was right about the bear case and wrong about how we got here. I said it was going to come from like 1 or 2 earnings, and we're already here now. We're down about 30% from the last time I made this video, which was just 2 weeks ago. As of today's close, March 18th, 2026, which is when I'm recording this video, we're currently sitting at a $15.16 stock price. And Vital Farms just hit a brand new 52-week low. In this video, I want to give you a full update where the stock is, why it got here, what the valuation actually looks like at these levels, what I'm personally doing with my position, and why, despite all the pain, I think this could be one of the most asymmetric setups in the small cap consumer space right now. All right, I want to show you how we got here. Vital Farms reported earnings on February 25th. And you can see here from this chart, there was a big price drop. I kind of got in here at this level, like kind of right before earnings. I wasn't anticipating playing this like earnings. This was more of a long-term play. Just earnings happened to get us. And just to recap, EPS came in at 35 cents versus 39-cent estimate. Revenue was at quarterly revenue was at 213.6 million, just shy of the 214.8 million consensus. It wasn't a disaster by any stretch, but in this macro environment, any miss is punished, and the stock dropped over 17% in a single session. Management cited increased promotional activity and supply chain challenges, and on top of that, the company lowered its 2026 revenue outlook slightly and announced that former founder Matt O'Hare is stepping down from the board. You had a trifecta of bad news hit all at once, and in the last 2 weeks, it's a lot of macro. Right now, let me be real with you about where I stand personally, because I think transparency matters on this channel. I'm currently down about 30% on my initial position in Vital. It's actually about 36%. And that does sting. And I'm not going to sugarcoat it, but here's what I'm doing about it. I'm currently running covered calls on my existing shares, and I'm collecting a premium while I wait. That premium is helping offset some of the loss and lowering my effective cost basis over time. And at these current price levels, I am planning to add more shares to bring that cost basis down further. Now, I want to be very clear. I'm not telling you to do what I'm doing. This is what makes sense for my situation, my risk tolerance, and my thesis. And as always, make your own decisions. Here's the honest truth, though. I don't think we've necessarily found the bottom. Momentum is bad. The macro is bad. And as you see here, I'm showing you a comparison. The blue line is the WTI crude oil price, ever since we started this war. And the line below that is where Vital Farm stock. You kind of see this like inverse relationship, right? As oil price tends to keep going up and there's more macro uncertainty, you can definitely see Vital Farm stock is just getting wrecked. When a stock is in a downtrend with this kind of selling pressure, it can absolutely continue lower. I definitely think $14 is a real possibility. Heck, it could even go below 14 if we get another macro shock or a hotter than expected inflation print, oil spiking even further, or another earnings disappointment in May. If you're thinking about this stock, you need to go in with your eyes wide open. No one rings a bell at the bottom. You cannot time it perfectly. Anyone who tells you they can time a bottom is lying to you. But here's the thing that keeps me in this trade, and this is where it gets interesting. At $15.16, the valuation argument is generally hard to ignore. Let's talk numbers. First, price to sales. The market cap right now is roughly $703 million. Full year 2025 revenue was $759 million. That means you're paying less than a 1x trailing sales for this company. And if you use their 2026 guidance of 900 to 920 million in revenue, you're looking at a forward price to sales of under 0.8x. For a consumer brand growing revenue at 20+% year over year, that is almost unheard of. Second, the PEG ratio. The trailing PE is around 11x, as you can see on this chart. And historically, again, VITL's only been around for about 5 years. Historically, its PE has been over 40x. And today you're getting at 11x PE. Earnings per share growth has been running at roughly 22% annually. This gives you a PEG ratio of about 0.5. And Peter Lynch, this guy, famously said, a PEG under 1 is where you find value. A PEG of 0.5 means you're paying half price for the growth you're getting. The stock's own historical median PE is over 40x, and today you're getting it at 11x. This is a company guiding to 900 million in revenue this year, 20% plus growth, a strong brand with real pricing power in the premium egg and butter space, and you're paying less than 1x sales for it. The market is pricing this like it's a dying business, and I think the market is wrong. What actually changes the narrative here? In my view, there are two catalysts, and the order matters. The first and most immediate catalyst is macro relief. The stock didn't get destroyed in the last 2 weeks because Vital Farms suddenly became a bad business. It got destroyed because the macro environment is ugly. Look, oil prices, sustained high interest rates, margin compression fears across the consumer space. Yeah, I mean, that's going to wreck the stock. Any meaningful shift in that backdrop changes the calculus fast. You know, if this whole war in Iran, if we start getting more positive news about that and you see oil prices start to drop, I think by default, you're going to see this stock start to recover. Not only that, you know, the Fed did just come out and, you know, pretty much put a pause on interest rates, and that's not helping at all. But again, if oil starts to come down, you can definitely see the stock rebounding. But again, I'm not the one to be able to predict that. Again, do your own due diligence. Again, I do think this is a really good opportunity to get in right now. You know, any one of those things, again, oil, interest rates, you know, cooling down, that will be the spark that gets institutional money rotating back into this beaten down consumer name like this one. You don't need all three, you just need one. And I think that one really is oil. The second catalyst is earnings. The next report is May 7th. If Vital Farms hits or beats on revenue and EPS, that's the first hard evidence that Q4 was a speed bump and not a cliff. That gives the bulls a data point to rally around. But I want to be clear. I think macro has to move first. If rates stay elevated and sentiment stays negative and oil prices stay high, even a decent earnings print might not be enough to move the needle. The wind needs to shift before the stock can really run. My base case for Vital remains $28 to $32 per share. And that's roughly 2x from where we are today at $15.16. And frankly, that's conservative relative to where Wall Street analysts have their targets. The average analyst price target is around $36 to $40, with some as high as $47. And look, I'm not chasing those numbers. I'm just saying if this company executes, gets any kind of macro tailwind, and the market gives it a fraction of the multiple it used to carry, $28 to $32 a share is very achievable. But I want to leave you with this. This is not a swing trade. The current market thematics don't support a company like Vital. If you want thematics, I don't know, look at a company like Nebius or Rocket Lab. I'm not buying more Vital because I think I know exactly where the bottom is. I'm buying more because I believe in the business, the brand, and the long-term thesis. And right now, the market is offering me shares at a valuation that I think will look like a gift in 2 or 3 years. We can't predict the bottom. We can only buy great companies at even greater discounts. And right now at $15.16, VITL fits that description. As always, this is not financial advice. Do your own research, know your risk, and I'll see you on the next one. If you found this video helpful, hit like and subscribe, and drop your thoughts on VITL in the comments. Are you in the stock? Are you watching from the sidelines? Do you think I'm just flat out wrong? Let me know. I'll see you on the next one.